Hello everyone, and welcome to this Forex session. I know David and I haven't been around specifically for Forex for a while. There's a reason for that. We've been working on a stock trading and investing program, but that's kind of, well underway now, so we can go back to doing the Forex session. So thank you very much for taking the time to come and join us today. But as always, before we start, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Okay, let me just take that down. And before we start, I just want to whiz over to have a look at the financial news for today. Obviously, what's been is the RBNZ rate decision, and in fact, it's quite it's new. The Kiwi is a currency that I was going to talk about anyway. So that's one of the reasons is because of the interest rate. The most important thing today will be later on, and that is we've got the FOMC minutes. So obviously that's going to have a big impact on not just the US dollar, but also the markets in general. The rest of the time we can see, certainly on Forex Factory, we've got Christine Lagarde speaking, and we've got Kuroda speaking as well. So a lot of central banks at the moment, not just the governors, but also the various members. And it actually ties in quite nicely about one of the topics that I wanted to cover for you. I always double check. I always go over to see what's happening on Financial Juice. I just refresh that for a minute. Here we are, and yeah, this pretty much covers what's over there. And my last calendar is the trading economics calendar, which is a little bit well, it's very comprehensive, and in fact it's defaulted to all the countries as we see here. I don't really want, Mexico and what have you. What you do is you can go in and filter and simply tick off the ones that you want. But for some reason this morning it's decided to include countries that I don't normally include. Okay, so that's what's been going on at the moment with regard to the fundamental releases, the what's been happening with the currencies. Oh, one more thing I keep forgetting. Obviously, I'm a bit rusty with regard to Forex. Just very quickly, let's just have a look at sentiment. We've got the Nasdaq's down a little bit at the moment, and we have, where am I? What's happening with the the Dow, the YM is down as well. So I mean, it's not surprising. It's since the last time we did one of these sessions, the markets have certainly been interesting, is one way that one word that we could use for them. Very tumultuous, a lot of turmoil. Are we in a bear market? Is there a recession coming down, coming down the road? Obviously, inflation is now the major talking point. But those of you who came along and to our sessions, last year, David and I had our own opinions about inflation, and neither of us are terribly surprised at what we are seeing at the moment. As traders, it's a great time. It's one of those periods that come along. They have been coming along quite regularly recently because of the pandemic and all sorts of other reasons as well, where it's just a great time to be a trader. There's lots of volatility, there's lots of movement, everything is moving. Trading opportunities are there if you know what you are doing. As an investor, it's not such a clever time because really, we've had this tremendous bull market. Is it now going to all come crashing around our ears? We've certainly got a very, steep correction at the moment. Whether it, I think it's trying to stabilize and possibly, have a floor put under the pullback that we're seeing at the moment, because everything's a little bit up it, I think, very much up in the air. Yes, it rallies, yes, it falls, but it doesn't, I wouldn't call it a massive sort of crash that we saw in 2000 and in 2008, but that may still happen. Right, that's sort of generally where we are at the moment. With regard to the individual currencies, we can see here, this is the Kiwi. As I said, we had the interest rate decision with the RBNZ. It was, the bank did exactly what the market expected. It went up by 50 basis points. It was fine. It's now 2%. And it's always one of these things with releases, is the reaction that you get in the markets and in the individual currencies. And you say, well, okay, if that was the market expectation, why did it sort of shoot up the way it did? It's because you have to kind of wait for the statement and the press release. And basically what the RBNZ have said is, yeah, well, this is what we've done, but by the end of the year, we think it's going to be 3.25, and then by next year, we think it's going to be 4%. They've actually kind of nailed their colours to the mast. And of course, if things get worse, it could be, it could increase. So the market kind of reacts to that. So you have the initial reaction, may not be excessive, particularly if the news is what the market expects. But then if whatever is said post the release, particularly with press conferences and statements, as we know, when Powell speaks, the market then has to absorb this this additional news, and then it will react accordingly. And that's kind of over. And in fact, the pair that I'm going to look at is the Euro New Zealand. You had this this sort of ramp up for the New Zealand, and in fact, it's come off quite strongly since the overnight news. I said I'm going to kind of focus on a couple of topics. One of them is to do with individual currencies, and I also want to have spend some time on looking at the longer time frame charts, because one of the, and also David is also going to talk about this, we're going to look at a particular sort of, if you like, technical pattern that we see a lot. I think we see it a lot more in the Forex market. This is not back tested, this is purely observational, and it's where you have two candles, that the two candles can then, what happens is you then get a reversal happen. We call it a two candle reversal. Either the candles are the same size, or you have an engulfing candle, or you have one candle and then the second candle will have a deep wick either to the top or the bottom. But it's three versions of the same thing. And when you see them on the charts, and particularly on the longer term charts, I think they do two things. First of all, if you haven't got a lot of time to trade, you could use that to look at potentially putting on longer term trades. Obviously, you've still got, you're going to have wider stops. And people say, well, I can't trade the slower time frames because I don't have enough money in my account. But you just have to trade very, very, very small size. David will talk a little bit more about, trading small size. He has an FXCM account which he literally trades micro lots, and it's kind of been pottering along for most of the year. And I think, are you anticipating doubling it by the end of the year, David? What's your? Yeah, he's going to try, and he's doubled it, and he's going to try and double it again. So that's one aspect of using this kind of candle pattern, if you like. The second one is also, if you see this pattern on a slower time frame, it kind of gives you, if you like, what is likely to be the bias in the faster time frames. That doesn't mean to say that, if you are on the very, very fast time frames, you cannot trade contra to the sentiment in the slower time frames. What it means is that when you are, so supposing that the euro has been selling off very, very strongly for most of the year, based on what the central bank has been saying, what Lagarde has been saying. That narrative changed on Monday. That has been changing now because it's to do with interest rate. The ECB is now looking actively to increase interest rates because of, to choke off inflation, as it were. While the euro was being selling off quite heavily, yes, most traders were probably short, but it didn't mean that there were never opportunities to buy the euro. There were probably, there could have been what we call a short squeeze, where all the shorts are literally squeezed out of the markets by other operators who have very, very deep pockets. That can happen as well. But the most important thing to bear in mind is whenever you take a trade that is counter to, if you like, the dominant trend, the risk on that trade is higher. Everyone talks about the risk of the trade in terms of monetary, in monetary terms, which is easy to calculate. What is more difficult to calculate is to assess and calculate is basically the risk of the trade itself. But even, as I said, even if you think, oh, the euro has been selling off really, really strongly, or whatever, or the pound, for example, has been selling off strongly, I'm going to, whenever I see a chart, I'm going to take every opportunity to short the currency. Fine, but you always have to bear in mind, yeah, the probability is probably on your side, but you do have these other factors. You have the factor of the short squeeze. You could also have the factor of, you could have a piece of news come in which will sort of upend that. Doesn't mean, that the dominant trend won't continue. It's just that, as I said, nothing is certain. Just because something has been selling off strongly or being bought strongly, it can never, reverse for any number of reasons. The currency pair that I'm actually going to focus on for both the kind of fundamentals and the technical picture is the Euro New Zealand, because as I said, there are already examples of this two-bar reversals on the charts, on certainly the daily charts, and also the Euro Canadian is the other one for, as I said, the technical signals. But this particular pair also really fits. It's a great example of what I was saying, the other topic I was going to talk about, and that is to kind of reiterate and cover again what I think as Forex traders we really need to get to grips with in terms of our currencies, and that is really get to know them and understand them. You almost have to make a profile of them, like profilers for serial killers, their behavior, what makes them move, what is going to drive them, what are the drivers. You've got to identify them. The good news in Forex is, we are limited to certainly 8 individual currencies. So doing this kind of checklist for each individual one, it may take a little bit of time, but by the end of it, you should be able to have a really nice profile, understand, what is likely to drive that currency, when it is likely to be moving. We've even got data for that as well. And that's on the individual ones. And then when they're paired together, it's the kind of interplay between the two. And if it's, for example, if it's interest rates, if interest rates are the main drivers for the market, as it were, and you have 2 currency pairs, and one currency, you have a currency pair, and one currency you have a central bank who is really being aggressive with pushing interest rates, while the other central banks in that pair is perhaps a little bit more hands-off. And we've seen that with the euro. That is when you get this, if you like, this divergence of, you'll see the divergence from a technical perspective on the chart, but you've also got a fundamental divergence. So one currency will push ahead because of interest rate differential. Interest rate differentials were always one of the big drivers. They're the big drivers of what we used to call the carry trade. They fell out completely. They just didn't exist. Certainly not in the 8 currencies that we follow. There's probably in the exotics and the lesser traded currencies, simply because interest rates, they weren't a factor in the economy. Central banks were desperate to try and light a fire under inflation. All the central banks were at 0, or negative. So that trade did not exist. The trades that were there were for other reasons. But at the moment, it's pretty much interest rates which are also driving flows into individual currencies. Now, I'm actually going to stop there because I'm going to come back to the this kind of put up. It's a kind of checklist. It's not sort of definitive, but it's just areas that you might want to explore. In the Forex program, we do cover this in more detail. We may even increase the information that we have in the Forex program, which has really been a direct result of the work that we have been doing on the stock program. It's taken us into perhaps topics that they certainly weren't so appropriate for the Forex market, but investigating a little bit in more detail, we've looked at it, Dave, and I thought, you know what, that's maybe got applications for Forex. So anyway, that's to come, but I'm going to pass over to David so he can get a chance to say hello and then come back to me.
Hi everybody, hopefully you can see my screen, and I'm sure you're familiar with this layout. This is on Ninjatrader. I'm going to move the chat box out of the way a little bit over there. Let's keep that up. One of the, Anna's mentioned the stock trading program that we're working on at the moment, which is going to be huge. And what's interesting at the moment, particularly, as Anna said, we were, for those of you who came along last year to all the webinars, one of our big focuses was very much on inflation, the fact that we were going to see a lot of inflation coming into the economy, particularly through the prism of soft commodities, and now we're seeing it globally. And what's interesting about the current phase of price action that really ties in nicely to what we're working on is now is a key moment in the whole economic cycle, where we are likely to see all of this reflected through the bond market. And as you would expect in a stock trading program, there's also a huge module on bonds, bond pricing, bond investing, how the bond markets work, what they reveal. And a huge part of that is actually what they're revealing in terms of yield curve at the moment, and it's fascinating to watch. So that will all be covered. But as I say, at the moment, it is, I would say we are at an inflection point, driven largely by the inflation, which is now not, I have to say, the typical inflation one would expect, and it's giving the central banks a massive problem because this is not inflation through economic heat. It is inflation that is being imported. It's inflation for many other reasons, and in trying to control it, the danger is that just using interest rates, they are more than likely they will likely drive economies into deflation, possibly even into stagflation, where basically you've got no economic growth, but inflation is still rising. And that's the big fear, certainly from their perspective at any rate. It's not really hit the headlines at the moment, but I can assure you that is what is likely to come down the stream given what's going on at the moment. So that's all in the melting pot. In terms of what we've been doing, we've been focused, last year we were very much focused on TradingView. This year we are very much focused on Ninjatrader. Just want to show you a couple of things we've been working on. Come back to this chart in a minute. Where are we? Currency, where are we? Okay, we are currency matrix. All right, there we go. Just to give you an example, for those of you who've got TradingView, got the currency matrix indicators, you'll know that this feature was added to TradingView as an on the currency matrix, basically to give you a sense of whether the data you're seeing, the actual numerical value you're seeing, is that a high, is it an average, and how does it compare? So you can see we've actually added that functionality to Ninjatrader, so that will be rolled out in due course. That's one of the many things we've been working on. It's just a great piece of information to have. You can see it down here. We're pretty much at the maximums here. Lowest 539, 539, 964. And you can obviously change the look back period on the matrix to make it longer if you wish. I think this is looking back over 7 bars at the moment, which is the default, but you can increase that to 14 or more if you wish. So that gives you a sense of, in terms of the currency pairs, for example, whether they are actually reaching extremes in terms of the matrix. And the matrix, remember, is very much it's a scalping, it's a much more intraday scalping tool because of the short look back period, whereas the currency array is a much longer term tool. We get this question a lot. Just flick up the array for a moment. Just pop over onto the currency array. There we go. Got 3 of them up there on very fast time frames, 1 minute, 2 minute, 3 minute. But the actual look back period on here is much, much longer. It's 70, 80 look back. So the actual timing, the transition from what we have here in terms of a bullish move, for example, on Euro New Zealand, this is on 2 minutes. So the actual timing, the transitional phase, this will hold much longer. And the analogy that I always highlight for the difference between the currency matrix and the currency array is that the currency matrix is very much like the trend dots, which work very close to the price action, whereas the trend monitor takes a much more stepped back look from the price action. So it doesn't move so quickly, it holds the trend longer. So please be aware of that. When you're comparing the currency matrix to the currency array, the currency matrix is much more a scalping tool. The currency array is much more of a trend trading tool, if you will, if you look at it in that context. Just hop over onto the market analyzer. This is something else we've been working on in terms of Ninjatrader. The market analyzer, we've now got, if you have the full package, and this always applies, if you have the full package of Ninjatrader indicators, then you'll get all of this free of charge. You will get the option to have this. This is on market analyzer, where you can input the indicators themselves into market analyzer. We're also in the process of developing 3 or 4 new indicators. They will come out first on Ninjatrader, primarily because that's going to be our focus in terms of launching the stock program. But if you have the full package of indicators, you will get those free of charge as well, as always. So it's another bonus of being invested in the full package. But this is what we've got here. You can see I've got volatility up here, I've got Camarilla, got the VPOT, got accumulation distribution up here, and obviously the trend monitor and the trends. Haven't fitted it all on here, but you can have multiples of these up as well. So that's another aspect of Ninjatrader that we have been working on. Just head back on over to the charts. Where were we? Currency majors, currency pairs multiples. There we go. Rusty like Anna. There we go. I just wanted to highlight something on cable, because Anna's been talking about slower term timeframes, and again, we get asked this question a lot, particularly in the forum, the VPA forum, for our students, a lot of whom are working full-time. Absolutely, couldn't agree with that more. It's one thing we always say, do not give up the day job. You can learn this and trade at the same time. You just have to move to slower timeframes. You can't sit in front of a screen all day long. We don't suggest you do. We suggest you keep the day job and learn while you keep earning your money for living on. Because I can assure you that if you pack it all in and think you're going to make a living from this from day one, you will be sorely mistaken. It's the one thing I remember, one of the many things I remember, to be honest, from dear old Albert all those years ago, 20, 22, 23 years ago, however long it was. And I have a visual in my mind of guys getting to the end of the 2-week program, ringing up their employers and handing in their notice saying, I'm going to, as of Monday, I'm a full-time trader. And I can assure you, none of them will survive, because the pressure of trading is enough on its own. You don't need the additional pressure if you don't have if you're a novice or you maybe got some experience. You cannot live with the extra pressure that comes with trying to generate a full-time income to live on from trading. By all means, when you've been doing this for 5, 10, 15 years, absolutely no problem at all. But in the early days, we always say keep the day job. And it's one of the reasons that we always strongly advise that if you're not in front of a screen all day, it doesn't matter. You can still trade using the daily timeframes. And this is cable, this perfect example of just looking at this breakaway here. This was in back end of April. Yes, it's a question of being patient. The one thing we're all really bad at in trading is patience, 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 patience. But if you're prepared to be patient, the trades will come, and it's exactly the same. This could be a 1 minute chart or a 1 month chart. It makes no difference. It happens to be a daily chart. You just had to be patient and wait. Yes, there was a lot of trading around the volume point of control. There was a strong platform. This is on the accumulation distribution indicator. Strong platform of support building below. We had some resistance building up here, just hidden underneath this solid line here. So this was getting stronger and stronger at the same time. This was pretty strong. And it's one of the beauties of having the VPOC indicator. The VPOC is the yellow line in the middle, running the VPOC with the accumulation distribution indicator in tandem, because what you will see is you will get this lovely channeling effect, because this is being tested all the time repeatedly. This is being tested up at the ceiling as well. And you get this almost perfect channel created with the indicator with a level above, level below, and you've got the VPOC in the middle of it all. And once that starts to break away, it gives you the opportunity to trade breakaways. I'm not saying breakaway trading is the be all and end all, it isn't, but it's just a really clean methodology, provided you have the patience. And the beauty of it is that not only do you have these levels set for you very clearly, very clinically, but in addition to that, it also gives you a very clear place to set your stop loss. And clearly the place you'd want to be is up here somewhere, provided that fits your money management rules. Yes, I accept this is over 100 pips. That's fine. When you're trading a daily chart, you're going to have wide stops. You're not going to be on 5s and 10s. You're going to be in the triple digit area. That's the difference between trading intraday and trading longer term. You have much wider stops. Not interested in what goes on intraday. You're not looking at the charts intraday. You have to accept the fact you're going to be trading through fundamental news. It comes with monotonous regularity intraday basis. So you have to have wider stop losses. But if that fits your money management rule, it's the ideal place. Put your stop loss in here. You've got so much protection in place, natural protection. You've got this level. You've got the VPOC itself. You've got the next level up. It's just a great tactical way to trade the markets, and then off we go, down we go. And this is where we are at the moment, all the way down here. We've had these rallies. It's not looking particularly strong at the moment. Why is it not looking particularly strong? Because we've had this rally in the last few days. We've had the uptrend. We had decent volume under this one, no problem at all. Indecision under this one, a lot of volume going in there, really not going anywhere. And then we've had the up day, was it 2 days ago? The volume's falling away. So basically, we've got a classic example of something that is not looking strong. In other words, it's relatively weak. Why? Because we've got rising price and we've got falling volume. So it's not looking terribly strong in terms of a continuation of that particular rally. In addition to that, we've come up to hit this little area of resistance just above 126. So, all the factors kind of line up to suggest when you're getting into this level, it doesn't look particularly strong, not looking as though it's going anywhere particularly longer term. And then, of course, you're looking at all the other aspects of that, particularly in terms of the dollar and everything else. So I'm going to drop that back. I'm going to pass back to Anna because I know she's got a lot more to cover. So as always, if you've got any questions, please just drop them in the chat box. Happy to answer them on air for you. It's okay. Anna's just sorting something out. Don't worry, we haven't gone away.
Apologies about that. I've forgotten how to use the sharing button, which is a bit silly. Right, so the two topics that I was going to cover, first of all, on the slower timeframes. In fact, the EuroCAD is actually the daily chart that I looked at, and where I was looking at these 2-bar reversals. And once you start seeing them, it becomes sort of obvious, as it were. And it's not, oh great, I see this happening, it's a great signal, and off I go. It's a bit like, when you see a strong hammer or you see a shooting star, that one did actually work really, really well. As we saw, a ton of volume coming into it. Volume is always going to give you that additional confidence, if you like, when you look at the price action signal. So that actually worked out quite well. But then it went into what I say, these 2-bar reversals. It carries on, and it then hits a level, and a support and resistance level, an important level. And if we look back over here to the left of the chart, we can see why it was, this price action great off that single signal, which is, I have to say, is unusual, but it does happen. And you think, off we go. It then does come to a pause point, and that is often because it hits, as I said, support and resistance. There are 5 elements of volume price analysis. There's the price action, the volume, support and resistance, candles and candle patterns, and time. And time meaning the chart that you're actually trading, and also the multiple time frames, as I've explained, not multiple time frames in terms of what is happening on a slower time frame. And you take another time frame as a kind of benchmark, because to see whether on the faster time frame, whether are you going with the general direction, the general bias that you see in that slower time frame, or are you actually going to take a counter trend trade, which is perfectly acceptable as long as you understand the additional risk that trade carries with it, as it were. Right, but to get back to these 2 bars, this is where you have 2 bars that are exactly the same size. We can see here it goes up. There's reasonable amount of volume underneath it. It all looks perfectly fine, but it hits this resistance. This is the volume resistance from the volume point of control. You always look to the left of the chart to see, has it reversed from this particular level before? So yes, that looks very encouraging, and as most traders like to see prices go up. We do have this bias even in forex that buying is good, selling is bad, as it were. But certainly as a forex trader, as a trader, you really have to get away from it. You have to be neutral. If something is going up, yeah, it's going to reverse. It's very different in stocks. It's a totally different kind of mindset for, if you like, investing, where you don't buy a stock because you're going to short it. It's, as I said, it is a different mental approach. But for trading, certainly in forex, you have to be aware that if wherever possible is, if you see a short position, a short opportunity, you want to take it. You don't fall in love with a currency or a currency pair. And also the other thing to bear in mind is markets always fall faster than they rise. So when they do begin to fall, and they fall dramatically, the speed with which you go, you only have to look, you can count the number of bars that a pair has taken to rise from one level to another over a certain period, and then you look at maybe when it was falling, and it was falling fast, to see how long it took to move the equivalent, and you will find when it's moving fast to the downside, it moves very, very quickly. Right, so you have the 2 bars that look like they're equal in size. And did we get a reversal? Yeah, we actually got a congestion. Then we have another one, and it carries on even lower. Then we have a little bit more congestion. We have this one here, you would say, well, it is a kind of engulfing, because it has but it has a wick to the top of the candle. So what that is telling us is, yes, it went up, but because it didn't have, because it had this wick to the top of the candle, this is when wicks become important. So you see it fell, it then tried to rise, you have the weakness. Did it fall immediately? No, it goes back into this consolidation. And then you have what I call this is an engulfing. You have the up candle here, and you have the candle, not huge, it engulfs the previous candle, and that is actually the signal for this pair to carry on lower until we come to this hammer candle, and we have the stopping volume coming in. We can see it under here, and it then manages to push it back up straight into a strong resistance. We have another equal candle here. We have another effort to rise again, two equal, you know, of equal size. That one you would have said, no, that didn't, because the thing with two candle patterns is we're very good at picking out the ones that succeed, and then we come across one and oh, well, that didn't work, because you know it's not nothing is 100%. You do have to look at the volume underneath it, look at the support and resistance. Was there any follow through? You know, you always do have, you know, you get the signal, you see the two candles, what is the follow through? The follow through is actually consolidation, and you have a down candle, you have a doji indecision, you have this candle with the wick to the top of the candle, and you go back to the original signal, which you know didn't play out, and you think, yeah, okay, you know, maybe this is the one that will determine it. And then you think, well, okay, well, where, you know, do you come off here? Do you go in there? And really, this is where you have to use the support and resistance. Once it breaks that support, and also the low of more or less the low of these candles, then you know you do get this little run down, as it were, back down again. This one again is engulfing, but look, it has you know, there is weakness to it, but it carried on higher. As I said, they don't all play out. You have to, you know, our eyes are always drawn to, oh, that worked out. This is just observational, but always look at the ones that don't play out, and think, okay, well, why didn't that play out? Was there a piece of news that day? What happened? You know, there are as I said, these are technical signals, but technical signals are always in the context of what is happening in the wider landscape. But it's a good exercise to do, and there is, you know, as I said, I like these 2 bars. David liked these two bar reversals, but as I said, they don't always play out. The objective is to find a signal that you feel comfortable with. You know, one of the questions we got asked is, you know, the person has taken the program but is totally overwhelmed. You know, where do I start? Well, you start with a signal, and you do it on the chart. As I said, a lot of traders like to use hammers and shooting stars, you know, candles with big, what they call pin bars. They're great signals, but they don't always work. That doesn't matter. Does it invalidate it? Well, of course it doesn't invalidate it. You know, if you read it with the volume and you look at where it is on the chart, where the support and resistance is, you know, and then gradually you add in, as I said, the fundamental side, the releases, what's going on at the time that the signal was being created, as it were. Now, the other 2 bar is, and this one I'm going to blow it up a little bit. I don't have a lot of examples here. Actually, this is quite a good one. Yeah, it's where you have 2 candles, and if you overlay, they're of different sizes, and you overlay. So you have a down candle and you have a little up candle next to it, but it doesn't, you know, it's not the same size, it's certainly not engulfing, it's sort of halfway, as we can see here. And if you put those 2 together, what you actually get is you get a candle with the wick to the bottom. So obviously there's buying there, so it's created its own hammer, as it were, and they can also be very, very effective. Or the opposite one here, as we see here, where we have the up candle here, and if this carries on today, this is going to have this. If you overlay that one on that one, you know, the price went up there, it's come back here. So what do we have? We have a weak candle. We have to wait till the volume actually completes on the day to see whether that is a genuine pullback, or in fact is it is it a reversal, or is it just just a minor correction. And to finish off this move lower, I haven't drawn in any lines because I think the trend line drawing tool on MT4, it kind of wants to do what it wants to do and not what I want to do. But if we go right back to this initial signal here that we saw with this 2 bars at the top of, significantly at the top of the volume point of control, and also at a point where previously this particular pair actually reversed as well, and we take that as our kind of starting point, as it were, and the trend lower, as it were. What do we have? We have a high, we have a lower 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 high, a lower high, and then we go into really a congestion. A congestion is like a neutral. It's neutral. There's no bias, and we know it's neutral because we have the volume point of control that also confirms this for us. And this is where you also get a lot of fakes. It tries to rise, it comes back, it tries to fall, and then it comes back. So this is what I'm saying about reading these signals in context. And you had a little bit of a consolidation there, you had a very tiny amount there, but generally, this is a really, it's not it doesn't go from here to here in a straight line, but by the how we determine a trend, in the sense that you have in a lower one you have lower highs, lower lows, lower highs, lower highs, lower highs. So if we were to draw a line, and I'm not going to use the tool they have here, I'm going to try and get some separate drawing tools, and it does, and you draw the line and you draw it all the way down there. In fact, if you were going to see this as a reversal, the trend lower, this candle is the first one that yesterday's candle, it is trying to another break from this consolidation. Is it going to be another fake? Well, we will have to wait and see. But it was going back to our 2 bars and what I said about if you overlay that candle, what you have is you have a wick, and driving. Well, it's actually an engulfing candle, so that's quite a strong signal. It's off a strong, it's been tested twice. We've got like a sort of a double bottom. You start off with the 2 candles, you kind of read those, then you bring in the support and resistance, then you look at the structure of the chart, then you kind of say, oh, well, I've got a double bottom here, I've got one there, I've got there. Well, maybe that is going to pull higher. It certainly went back to the volume point of control, and now it's trying to move away from there. This is the daily chart. You will see this on the weekly charts as well. What it means if you are on the faster time frames, as I said, you can see that the euro, as I said, it's had a pretty torrid time, mainly because the ECB, Lagarde, they haven't really, they've kind of, no, we're not going to raise interest rates. It's, economy can't take it. Blah, 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 blah. Then Monday is there's I believe there was a blog post that she wrote, and suddenly they've got a roadmap for raising interest rates, and it will start next month. Although I think they zero or negative, as it were, and the whole picture for the euro seems to have changed. So this is where, if you like, you have got to know your profile, know your currency, understand what is going to drive that currency. And as I said, the euro New Zealand has just been a great example today, especially for the New Zealand, because of the RBNZ. Now, these 2 candles, if you don't want to go, you can use them on your benchmark chart. The other chart to use is see what you can spot on the hourly chart as well. It's a really good exercise, first of all, to help you understand the candle patterns and to sort of pull together the sort of elements that we have for, as I said, volume volume price analysis, and also the tools that we've developed, because we feel that they present this narrative for what you're seeing on the chart in a very, very visual way. Right, that's what I'm going to say. To get back to this profile, your currency, I'm just going to say very, very quickly, they're not in any sort of particular order. So you can either take some notes. What I'll do is when I put these together, perhaps in well, certainly for our Forex students, it'll be in the back of the program, but I'm sure they won't mind if we share it with the other traders as well. But profile your currency. Obviously, the central bank. The central bank, you've got to know who the governor is, who are the main members, but more importantly, when they comment, the individual members, who does the market pay attention to? And it's certainly very important with the Fed. Not all members are have an equal impact on the market, and they will have an impact on the market if they're actually close to the decision maker, or basically they have some kind of vote. And if they don't have a vote, then the market say, yeah, well, that's awfully interesting, but you don't have any. What influence do they carry for making any decisions? Then you obviously got to know what the key fundamental dates are, and at the same time, it's all very, very well known. And we've got NFP, or we've got this or that. Is that item of news? Is it actually something that that bank is particularly focused on at the moment? At the moment, everything is inflation. I think it's this week, we've got the PCE. The Fed, their preferred metric of inflation is the PCE data. So yeah, the CPI is important, the PPI is important, all the other inflation metrics are important, but the one that they really, really focus on the most is the PCE. So because fundamental data is cyclical, it has a cycle, just like the economic cycle. Then you have to say, well, what are the main drivers for this particular currency? Is it a risk currency? Is it a commodity currency? Is it a safe haven currency? And what's driving it at the moment? Is it interest rate differentials? And the commodity currencies, such as the Aussie, New Zealand, and the Canadian, yeah, they're also risk-off currencies as we talk. But if commodities are going higher, and they're being driven higher by inflation, they will carry on higher, not necessarily because of the sentiment. So their drivers will come into play at different times of one driver will carry more weight at different times of the economic cycle. Then we have the bond market. Now the bond market is a section all of its own, and all I'm going to say about the bond market is certainly for the euro, you have to look at the spread. So the euro, the spread of the bond between the individual bonds of the individual countries that make up the euro. So for example, if the spread between the Italian bonds and the German bonds is widening, then that tells us that there is stress. As I said, that's a whole topic of its own. The volatility, right? This one I know our students will have seen this, but I'm so grateful that investing.com have actually cleaned this up, because the previous charts were absolutely terrible. Right, volatility. This is from the options market, and it's the implied volatility. Now, as I said, options are massive in stocks, and they are also important in Forex. And the stock program has this big section on what do we mean by delta, what is gamma, what is a gamma squeeze, and these are expressions that you may or may not have come across, and you think, oh my goodness, I've got to learn all this stuff as well. But for Forex, it's a great way of knowing whether based on what the implied volatility is for the currency, is basically how, is it going to move? Is there any is it got some momentum behind it? Volatility is not directional. We don't know whether this is going up or whether you have to look at other metrics for that. But what the implied volatility tells you is, is it basically going to be a currency or pair here that's going to whiz about all the time, or is it fairly steady and solid? And if it's very low, then it's probably more interesting watching paint dry. And just to give you an example of the difference, this is, and you can go and look at the charts. I'm not going to pull up the charts now. If we look at something like the Aussie dollar, now the Aussie has been, the volatility picked up a little bit because there was the election at the weekend, but this is the 1 week volatility, and we can see here it's actually falling. This is the current, this is a week ago, this is a month. So, you know, whatever's happened is obviously dying down. This, as I said, the election didn't really cause a great move in the Aussie. If we look at the 1 month, where are we? Yeah, it's sort of, you know, it's kind of 13. It tells us, what does that number tell us? It tells us, I think anything over 10, 12, 13, you know, going up to 15, yeah, you know, there's something, there is some movement in that particular currency pair. All you need to do is just go at the chart, you know, look at it and think, okay, it said 14, 15. What am I seeing? Am I seeing a trend, or am I seeing it in you know, in consolidation? And Euro shift is a great example. It's the sort of that's a 7 or 8. Go and look at the chart. When that's 7 or 8 on 1 month, what's the weekly? Pretty much the same. What is that telling us? Yeah, there's probably going to be movement on it, but it's, you know, as I said, probably more interesting watching paint dry. But, you know, go and check out. It's only when you compare it to something like the dollar, Turkish lira, and you look at the numbers up here and you think, oh my goodness, that's 54%. As I said, it's not directional, it doesn't tell us whether it's up or down. It simply tells us that it is a very, very volatile pair, and you trade it at your peril. You may like all that whizzy stuff, and certainly if you know, if you've got a volatility indicator, at least you have half a chance of knowing when it's, you know, it's going to go up, going to go down, it's going to reverse. People do trade volatility. It's a bit of a, you know, white knuckle ride. That's what they like to do. You look at the 1 month volatility, it's even higher. It's 62%. You think, oh my goodness. Dollar Mexican is a dollar peso, a Mexican peso. Yeah, it's got, you know, it's going higher. Could be all sorts of reasons. Assuming that also assumes your broker is allowing you to trade these pairs. What is the spread? You know, it's all very well saying, right, I'm going to trade the Turkish lira, but you know, it comes with may not be quite so straightforward. So that's the volatility. You can also check out the days that a particular currency pair moves, again at investing.com. You can check it out and it will tell you, based on, you know, statistical data, you know, what's it going to move on a day, on a week, on a month, and it even tells you the time. So it kind of tells you, is this, you know, is this pair, is it best to trade it in the London session, maybe the Asia session? We've got Euro New Zealand, or is it the New York, you know, the North American session? That the data is there, and it gives you a kind of sort of average pip value on the hour. All decisions that you can, well, not just decisions, but it will tell you not just about the currency and obviously the currency pair. This is, you know, I'm talking about the euro at the moment. You still have to see it in relation to another currency, because this profile you will do for the euro, and you will do, hopefully you will do it for all 8 currencies. And then, as I said, you've got your profile on one, your profile on the other, and you've got all the, you know what's going on in the background, and you think, is this more likely to go up? Is this one likely to go down? You know, and obviously you look at what's going on in the charts. You look at the currencies correlate. You know, what does the pound, it used to be the pound and the euro used to move very, very closely. If the pound went up, the euro went up. Doesn't happen anymore. The futures market, what is happening in the futures market? A classic example where the pound is there's a lot of shorts in the British pound, and you think, oh great, you know, it's not extreme, but it's getting that way. Right, I'm going to sell the pound. What do we have? We have, as I said, we had a short squeeze, but the CFTC beta is, you know, keep a watch on it because it can help. And you know, then we go back to the technicals. Does a particular currency pair, does it like certain setups? You know, is it certain chart patterns? Again, it's all observational. And finally, to help you with getting to know your currency, you've obviously got the news feeds. Find a couple of good sources. Follow some people on Twitter, and you think, yeah, this person has written, writes about the euro and the various euro pairs, and just check out what they say, and you think, yeah, okay, they kind of know what they're doing. Or what I do is you actually set up a Google alert for the euro or Christine Lagarde, or I've got one set up for the Federal Reserve. So what I get is I get an email from Google saying every kind of mention of the Federal, you have to do various versions of it. And you think, oh, okay, fine. And it just builds to my knowledge of that particular currency, central bank, whatever it is that I'm trying to understand and learn in relation to a particular currency or a currency pair. Right. Euro New Zealand, what's happened here? Let's have a look very, very quickly. Let's have a look at the weekly chart. We're actually moving back to the volume point of control. We didn't have any, well, we had here, if we look back, but we are in a consolidation phase. We're not in any kind of trend on the weekly chart, but we can see immediately, because I've been talking about two bars, we've got a really nice engulfing candle here, straight back into the consolidation of the VPOC, back sideways. We have another attempt to break out. We do have a 2-bar here, not the same size, so obviously that would have, you do have a wick onto that candle, and we did get a nice move lower, but it triggered the volatility candle. Then we have a doji with a lot of volume underneath it, a lot of indecision, and we're back. We've got like another consolidation here. We have got wicks to the bottom of the candles, which does tell us there has been buying in the consolidation. We've got buying here as well, although as I said, this is primarily indecision. We've got these two candles here, weakness there. You could say that engulfed that one, but the weakness came in telling us, it's not going to go higher. But these two are very encouraging, nice lot of volume underneath it. And then we're back again, back in this little move, but back to the volume point of control. So with the Euro New Zealand, it's not clear cut on the weekly chart. Yes, we have the signals, but you've got to read them in the context of what the chart structure is, what is the chart pattern, right? That's what I've got to say. As I said, an awful lot to cover. It's our first one back, so I hope we haven't given you too much of a brain dump. I'm going to pass back to David. It is a long video, but I know people who come onto the channels, they do watch it because, hopefully there's something, you'll have heard something that you didn't know before.
Thanks, Ali. Hopefully you can see my screen. I'll just turn around. Yep, great stuff. Okay, I'm still with cable. Still looking pretty weak, and really just to highlight that, just head over onto the multiple currency strength indicators, currency strength multiples. There we go. That's what we're seeing at the moment. This is on 1 minute, 5 minute, 10 minute, 15 minutes. So it's been pretty good. And as always, it comes down to your time horizon. On the 15 minute, still maybe got some way to go, but we got up well up into overbought here. And the only downside, I would say, of this particular opportunity, if I was looking at it, is very much that by the time the pound starts to roll over, the dollar, the red line, which is this line here, is very much higher than I would actually like it to be. In other words, in a perfect world, what I would like to see is the currency at the top. For those of you who come along regularly last year and all the years we've been doing webinars, you'll know what I'm about to say. I love trading reversals. That's what I'm looking for all the time because I'm greedy. I like to get in early. I don't like jumping on a trend because I've lost part of the reversal anyway. Part of the profit has already gone. I can't get it back. It's gone. It's history. So I'm always looking to get in early, and in getting in early, I'm prepared to accept the fact that the currency or currency pair may consolidate at that level. It may move around. It may go further into overbought, oversold at both extremes. But I'm prepared to accept that, and for that I pay a higher price. I set my stop losses much wider. The reason that I don't particularly like this opportunity, and I wouldn't have considered it personally, certainly from an intraday perspective, anyway, longer term, very different picture, because the pound is up at the top, but the dollar is also up near the top. And ideally what I want to see is the currency up here, one currency up here, and another currency down here. So in terms of looking at that as an opportunity, if I was looking at euro pound, for example, I've got euro at extreme oversold, I've got pound at extreme overbought. That to me is a more balanced opportunity, because I have the opportunity for this to travel all the way up here, and I have the opportunity for this to travel all the way down. What I don't like about the cable, certainly in this time horizon, is that it's skewed, and it's skewed up at the top here. In other words, the amount of travel left for the dollar, yes, it's carried on higher, but certainly at this sort of level, it's way up here. So when you're looking at the CSI, what you're looking for is, in an ideal world, let's face it, the ideal world doesn't always exist, but ideally what you're looking for is you're looking for a currency up at the top, and you're looking to match it with one down at the bottom, because then you've got the opportunity for an equal level of travel. And even if one doesn't go all the way higher, even if you've got enough, as you have here in selling of pound, you've got enough momentum on its own to deliver a trend. Even if one of them stalls, you've still got an opportunity to make some money. You're not going to be stranded. With one of the currencies high up on the chart, either at the top or bottom, depending on which way you're looking at it, there's always an opportunity that you may get stranded into a congestion phase and it just not develop. I mean, that's trading. We accept it. It's just part and parcel. But what I'm saying is what you're looking for ideally are those opportunities where one is at the top, one is at the bottom, and then you've got the opportunity for the two of them to travel in the same direction, hopefully with sort of similar momentum, although you can't guarantee that. And then you've got a nice even trade, which is symmetrical about the overbought and oversold regions. So I just wanted to highlight that there. Just go back onto the currency pairs multiples, and I just want to flick over on something else as well. It's still developing nicely, as you can see. So despite the fact that it had that skewed aspect to it. Just want to show you this on the 5-minute. This is, I was talking earlier about the daily time frame for breakouts. This is a 5-minute, but the principles are exactly the same. You're in congestion, you've got the VPOC here. We've had a lot of, this is around 8 o'clock our time, so you're expecting to see tons of volatility. It's always the case. You expect to see all this jagging around in price action, and then it settles down. We get towards 9 o'clock, you start to settle down. What you're looking for, you've got the VPOC here, you've got this ceiling of resistance here, you've got a platform of support. We break away through it, we develop another one, but you're breaking away and you're looking at the volume as it develops, obviously, and all the rest of it, and on down we go. It's not particularly strong. It hasn't developed into a price waterfall. Nevertheless, it's a decent move. So I just wanted to highlight the fact that breakaway trading, it's not restricted to just the daily chart. You can apply it to any particular chart you like. Got the 15-second up here. You can see the dollar is still rising. Again, his favorite time frame. I'm not suggesting you do it, but again, if you're learning, the faster time frames are a great place to learn. And in fact, it's one of the points I made in the VPA room. Use faster time frames for learning, not necessarily for trading. If you're a novice, if you're less experienced, don't trade these ridiculously fast time frames. I'm quite comfortable with it. We've been doing this for 20+ years. But what it does teach you is it teaches you VPA very quickly. And you've got a nice example here. You've got a price waterfall, breaking lower, moving through the low volume point of control here, which is what we expect to see, because volume on the VPOC histogram works in exactly the same way as price-based support and resistance. If you're hitting into areas where you've got high volume or you've got volume building, then expect congestion. If the price is approaching a low volume node, as it did here, you expect it to move through there pretty quickly. That's how you use the VPOC. It's used in exactly the same way that you're using support and resistance on the accumulation distribution from a price-based perspective. There you're using it from a volume-based perspective because the principle is exactly the same. If you've got a big volume building as you have here, then if the market comes back up to this level in the future, you can expect the market to congest at that point. If you get down to a low volume node here, you expect the market to go through pretty quickly, which is what it did. You've got lovely rising volume here, falling price, rising volume. That's what you want to see. The one is confirming the other. Volume, price, and agreement. You're not looking at it from an individual perspective of one candle versus one volume, but you're looking at it from the perspective of the flow of price action, if you will. We've come down to congestion, we're in congestion, volumes building. It's what we expect to see. And if this congests further and continues to congest at this level, then ultimately what will happen is the VPOC here on this time frame will hop down to this level because this volume here will then exceed the volume up here. Do not think the VPOC is a piece of is like an anchor that we put out on the boat that is there forever and a day. It isn't. It's a thing which moves. It adjusts according to the volume as it comes in and builds and constantly rebuilds on the chart. You've got a volume point. You've got a volatility triggers arrived on the 3-minute chart here. So you're now looking for the possibility of congestion, which we're seeing over on the 15-second chart, possibly a reversal up into that. But at the very least, you're expecting some sort of pause point. It doesn't happen every single time. There's nothing that happens every single time in trading, but it's a great signal. And as I've said many, many times before, if you're in a trade, if you were in this trade, if I was now in this position, I had a decent amount of profit in there, and this was my primary trading window, then at this point I'd be looking to close out because I'm not interested in sitting through a reversal. I'm certainly not interested in sitting through painful congestion for the next 5, 10, 15, 20 minutes, whatever it may be. I'm quite happy to bank my profit, get out, that's it, I'm going to wait. If the market carries on to the downside below this level, fine, I'll just jump back in again because it's the cost of trading now is peanuts. It truly is peanuts. Just move that. I just want to slide this window across very, very quickly. Then we've got to wrap up because we're on way over time. Just to highlight one or two things here. This is the Aussie dollar, which I just wanted to show you, but as we're way out of time, but there's lots of 2-bar reversals here. There's all sorts of signals here. You've got this, this is a classic example of a 2-bar reversal with an evening star here. Sorry, a morning star. You've got the little doji, you've got the 2-bar reversal, little doji, and in addition to that, you've got support underneath. You've got signals up here, really nice signal there. Signal of weakness. Bearish engulfing candle follows. We go through this level here. You've got another 2-bar here. We come up and retest it. It fails. 2-bar reversal. So you've got a nice level in there. On down we go. Then you get volatility, bang. You get a volatility bang in the other way. So that's a 2-bar with double volatility, if you like. You've got resistance overhead. Down we go again. Further weakness here. Down we go again. Then we get a 2-bar reversal at the bottom. Up we go. Another one here. Up we go. And on we go. And then we're coming up to this very strong level of resistance. That's been tested 6 times and held in terms of accumulation distribution. This is on TradingView. This is something I use all the time. This is using the currency indices themselves. Top left, I've got the pound. Top right, I've got the yen. Down here, I've got the dollar. And over on the right, I've got the euro. So this gives me an instant view, what is going on in terms of my primary currencies. You can see the dollar here is rising very strongly. You've got the 2 moving averages underneath, really supporting that. Moving averages get such a bad press. In congestion, yes, they're not very helpful. But once you start to come out of congestion, as here, you will find them very helpful because you'll find that the market tends to regress to them, it tends to test them, it tends to bounce off them. That's the point to use them. It's just interpretation. It's understanding what phase of price action you're in and then using the indicators accordingly. So that's there's the pound. That's what the pound is doing at the moment. So that's why we're seeing that nice trade there in terms of pound selling, dollar buying, still carrying on, which is nice. This is the yen. Not a lot going on the yen. I've got the VIX up here somewhere or the other. There we go. That's what's going on in terms of the VIX. It's all going sideways at the moment. In terms of what we're seeing in sentiment, if you like, the VIX is not terribly high at the moment. We got up to 36, 37 the other day, but it's not terribly demonstrable at the moment. Finally, I know we've got quite a lot of new visitors in the room this morning. This is very quickly, this is an unusual indicator. We're selling a huge number of these. It's extremely popular. It's the Renko indicator on TradingView. And the reason it's so popular is because there are two facets to it. If this looks a little odd, then I'll just show you what it is. It's what we call the time accurate Renko as opposed to traditional. If I just flick that on, that is traditional. The traditional Renko I'm sure you're familiar with, but because Renko is a non-time-based indicator chart, it's very difficult at times to actually tie it up to where you are in terms of the price action on the candle chart it's associated with, because the Renko brick will build according to how quickly the brick size, the default brick size you set it to, or the value that's associated with it reaches that point. Now that could be at any time frame. It could be a millisecond, could be half a second, 5 seconds, could be whatever time frame. And that's when the brick will complete and move on to the next one. So Renko is independent of time. And actually what we've done here is we've created what we call the time accurate Renko. And that now matches the associated price action up here. So what you're seeing on the Renko bricks as they build into these patterns, you're actually seeing congestion on the Renko into the trend, congestion, reversed a little bit there, it's moving sideways, but that's what you're seeing. As I say, we call it time accurate. There isn't another one out there as far as we know. It's extremely popular, traders love it, because it gives you these two aspects of a Renko. You can look at the Renko as non-time based, or you can look at it in terms of this, which is the time accurate version. And in addition to that, it just smooths out the price action as well. So it's a really neat indicator. And as I say, we're selling a lot of those at the moment. Finally, just to wrap up, I know some of you have seen this before. This is the equivalent currency strength indicator for cryptocurrencies. The beauty of this is you can add any particular cryptocurrency you choose, provided it's on the TradingView platform. So you can have any number up here. I think we've got a maximum of 11 or 12 from memory, but you choose which cryptocurrencies you want to see on the cryptocurrency strength indicator. And they're all matched against this one here, which is the red one, which is Tether, USDT. So they're all matched against the US currency, the US dollar, if you like. So they're matched against Tether. And it's very unusual to see what we're seeing at the moment. Generally speaking, the cryptocurrencies all move en masse. We've got this one, which is not. So it's very unusual. Finally, just over on the right-hand side, this is the equivalent that we built in terms of a market analyzer, much smaller version of it than we've got on Ninjatrader. But nevertheless, you can see here, we've got volatility, we've got Camarilla, got trend monitor, trends up here. It just gives you a really clean view without having to look at all the various charts all the time, just what's going on, and just able to pick those trades off as they come and go. And also gives you a sense of whether the market moves and whenever you're looking at a universal, or whether they are just simply associated with that particular currency pair or cryptocurrency, whatever it may be you are looking at. Yes, darling. Yeah. They are, yes, they are default. There are two moving averages that come with the indices, but you can set them to what you wish. Yeah, you can. Yeah, I can't remember without looking. But yes, you can. The indicator itself comes as the index and the moving averages. You can't add more than that, but you can certainly play around with the settings and choose whichever you prefer for that particular indicator. Hope that answers that one for you. Very quickly, just to round up where all the bits and pieces are, you'll find all the indicators over at quantumtrading.com, which is here. Those are the platforms: MT45, Ninjatrader 7.8, TradingView, and of course TradeStation as well. Whether you buy one or the full package, you will always get a credit for whatever you purchase in the future if you want to upgrade. For example, if you start with one indicator, and maybe you want to buy a bundle, or maybe you want to upgrade to a full package, or maybe you want to go onto the Forex education program, you will always get a full credit. And it doesn't matter whether you bought that last week or last year or 10 years ago when we first started. We have you on the system and you'll get a credit for that. You can upgrade accordingly. Remember also, if you invest in a full package, as I said earlier on, you will receive all future upgrades free of charge. So those of our customers who are on the Ninjatrader packages, full package, they will get all the new indicators we are developing on Ninjatrader. Ultimately, they will be rolled out onto the other platforms also, and if you have the full package there, you will get them too. They will be very much stock specific. I should say volume specific, but related to stocks. Can't say too much more at the moment, but that's the kind of route we're going there. But they will be available, as I say, on all the other platforms in due course. So we're very much focused on Ninjatrader right now. You'll find all special deals up here as well. There are some bundled deals where you can get 2 or 3 indicators as a special deal as well. This is where we are with the Forex program. It's been hugely successful. It's been very, very popular. And last year we bolted in the funded program, which allows our students to trade our money basically. You can trade on an evaluation count. You decide what level you go in at, 5,000, 10 or 15,000, and you trade right the way up to 2 million. And you're trading our money, not yours. There is an entry fee, but that's it. Once you've paid that fee, you're in, and then you trade our money. And of course, there are risk and money management rules in there. There have to be. It is our money, so we like to try and protect as best we can. But nevertheless, the program is there for our traders to leverage that knowledge that they learn on the program, in the funded program and in the Forex program itself. It's huge. I think there are over 250 or 300 hours of video, something like that. It's massive, as the stock program will be as well. It's a huge program we are putting together, a massive amount of information, and it's just taking us, as always, a lot longer than we anticipated. But we prefer to put in all the information that we think you will need. There will be live webinars with them, of course, as well, but all the information that you need to trade and invest in stocks, because there's an awful lot out there that is not covered, and we are covering it because we believe that's what you need to know to be successful and succeed in this business. Finally, over onto Anna's site, this is where you'll find Anna's analysis down here, the latest blog posts, VPA charts of the week. Anna does this all the time. There's lots of stuff down there as well. Also on Facebook, a huge number of followers on Facebook and Twitter as well. And you'll find all the books up on Amazon. They are massively successful. And I have to say, we are very humbled by the comments that we see up there across all of them, particularly on the VPA book, the stock trading book as well. How the VPA book has changed traders' lives in terms of their understanding, and another tool in the armory. And it doesn't mean that whatever you've done before is wasted, because there are so many traders who have a methodology that are comfortable with, but there's a piece missing, and they find that volume actually gives them that little aspect, that element that they couldn't grasp, and they've then wrap that into their own approach. And really, that's what it's all about. So thank you very much indeed for coming along today. Hope you've enjoyed it. I won't say we will be back next week, because we are massively occupied with this program at the moment, but we will try and drop in webinars for more frequently from now on, as we're starting to get on top of all the work. So thank you again. If you have any questions, always happy to answer them. Anna@annacooling.com or David@quantumtrading.com. Enjoy the rest of the trading day and the rest of the trading week. See you soon, and bye for now.